Something strange is happening right now in the global financial system, and almost nobody is talking about the real reason why. Over the past few decades, we have been told repeatedly that the end was near. We watched a massive housing collapse, a global shutdown that froze entire industries overnight, skyrocketing inflation, and the sharpest interest rate hikes in a generation. By every traditional rule set of economics, the engine should have seized up. The math said we were headed for a cliff. But instead of crashing, the system just kept moving. It is almost like a high performance car running at full speed without any oil, yet the engine refuses to explode, continuing to purr along as if laws of physics no longer applied. Most people look at this baffling resilience and assume the answer is simple. They think the government is just printing money to save the day, or that the official numbers are being manipulated behind closed doors to make things look better than they actually are. But that is a surface level illusion. That is just what everyone believes because it is easy to understand, fitting neatly into standard political narratives. The truth is much stranger and, frankly, a lot more unsettling. The economy is not surviving because the old systems are working well or because politicians have suddenly mastered macroeconomic engineering. It is surviving because the traditional rules of capitalism have been quietly, systematically replaced by something else entirely. A hidden safety net that operates in the deep shadows, far away from public scrutiny and democratic oversight. To understand how we got here, we have to look back at how we used to think about economic disasters. For nearly a century, the prevailing wisdom among policymakers and academics was that the market was fundamentally self correcting. If a company made terrible bets, it went bankrupt. If a bank took on too much risk in search of short term profits, it failed, and its depositors or investors bore the consequences. This pain was considered necessary, even healthy. It was the economic equivalent of a forest fire, clearing out the deadwood, the inefficient firms, and the bad debts so that new, healthier growth could take its place. But somewhere along the line, during the panics of the late 20th century, the people running the show decided that the forest was simply too large to let burn. The potential damage of a full scale purge was too terrifying to contemplate, threatened to drag down society itself, so they resolved to fight every spark. Which brings us to a central mystery that should make you scratch your head and question everything you know about finance. If the system is constantly being saved from the consequences of its own mistakes, where is the risk going? You cannot just delete risk from the universe. It is a fundamental law of economic thermodynamics. Risk can change forms, but it must live somewhere. If a giant financial institution makes a multi-billion dollar mistake and does not collapse, that loss does not just magically vanish into thin air. It is absorbed, hidden, or transferred to someone else who often has no idea they are holding the bag. Here is where things get interesting. The first layer of defense is the most obvious, the one you see on the evening news and read about in mainstream financial publications. When a crisis hits, central banks, like the Federal Reserve System, step in to lower interest rates and flood the market with cash. This is the traditional financial plumbing being opened up to maximum capacity. It is designed to make borrowing incredibly cheap so that businesses can keep hiring, consumers can keep spending, and the wheels of commerce can keep spinning without friction. For a long time, everyone thought this was the ultimate cure. It was like giving a crashing patient a massive dose of adrenaline. It worked beautifully in 1987. It worked in the early 2000s after the dot-com bubble burst. And it worked during the initial stages of the great financial crisis of 2008. But then that raises a bigger, much more uncomfortable question. What happens when the adrenaline stops working? What happens when you have already lowered interest rates all the way to zero, exhausted your traditional tools, and the system still starts to choke and gasp for air? This leads to something even stranger, the second layer of the hidden system. When the traditional plumbing could no longer handle the immense pressure of globalized debt, the gatekeepers had to build an entirely new set of pipes overnight. They started buying up assets directly through a process euphemistically called quantitative easing. They did not just lend money to banks anymore. They started buying government bonds, mortgage backed securities, and eventually corporate debt. In essence, the referee of the game decided to start buying the players' equipment and financing their salaries just to keep them on the field and prevent the stadium from going dark. This created a bizarre reality where the stock market could boom to record highs while the real economy on Main Street was struggling to breathe. It felt completely disconnected from everyday life because it was. But that is still not the real story. That is just the public layer they let us see because it can be rationalized on a balance sheet. If you dig deeper into the modern financial architecture, you find the third layer, the vast, unregulated world of shadow banking. Over the past 15 years, stricter regulations like Dodd-Frank were placed on traditional commercial banks to stop them from taking dangerous speculative risks with consumer deposits. So, did the risk disappear from the global marketplace? Not at all. It simply migrated to where the light does not shine. It flowed rapidly into private equity firms, massive hedge funds, non bank mortgage lenders, and complex, unregulated financial entities that operate entirely outside the view of regular regulators. Today, this shadow network manages trillions of dollars, operating with immense leverage and zero public accountability. It has become the invisible scaffolding holding up the entire global corporate apparatus, acting as a massive buffer that absorbs shocks, but also concentrates hidden vulnerabilities. And this is where everything changes. The stakes are continuously growing because this invisible scaffolding has created a massive, intractable paradox. By preventing smaller, localized fires, we have accidentally built a system that can only experience total peace or total annihilation. There is no longer any middle ground, no room for minor corrections or healthy downturns. Companies that should have gone out of business years ago, often called zombie companies, are kept alive on a permanent life support machine of cheap debt and rolled over credit lines. They do not innovate, they do not grow efficiently, and they drag down overall productivity, but they employ millions of people and owe billions to the shadow banks. If you let them fail, you risk a systemic domino collapse that could take down the entire network. If you keep them alive, you slowly drain the vitality, growth, and hope out of the entire economy. So, who actually benefits from this permanent state of artificial survival? That is the question that unlocks the final reveal. The hidden system is not designed to create broad prosperity, wealth equality, or a level playing field for entrepreneurs. It is designed to maintain stability at all costs, prioritizing order over progress. The big winners are the largest asset owners, the massive multinational corporations, and the institutions that are deemed too interconnected to fail. They receive all the upside of raw, unbridled capitalism during the good times, reaping historic profits and a fully socialized safety net during the bad times. Meanwhile, the average person experiences this survival not as a triumph, but as a slow, grinding pressure. Rising living costs, asset price inflation that puts homeownership permanently out of reach, and a lingering, frustrating feeling that the economic ladder has been pulled up just as they started to climb. The real explanation for why the global economy keeps surviving things that should destroy it is not economic genius or superior technological planning. It is a profound, paralyzing fear of the alternative. The gatekeepers have realized that the financial plumbing is now so complex, so heavily leveraged, and so deeply intertwined globally that any major disruption anywhere in the world could trigger a cascading domino effect that no one can predict or control. So, faced with the prospect of a total meltdown, they choose to build bigger pipes, print more words, invent new liquidity facilities, and absorb more toxic risk into the public balance sheet, hoping they can outrun the final bill forever. But that leaves us with one important implication that remains completely unresolved and ignored by the political establishment. We have successfully traded short term volatility for long term fragility. We have created a system that is incredibly resilient on the outside, polished and protected by endless interventions, but increasingly brittle on the inside. By constantly engineering a way out of every single crisis, we have eliminated the market's natural feedback loops, making it impossible to know how much weight the structure can actually bear before it snaps. We are floating on an ocean of artificial stability, watching the horizon, and wondering exactly how long the illusion can last before reality demands its payment.